Kenya's central bank held its key benchmark lending rate at 8.5%, saying the East African economy's inflation rate was still within its medium-term 5% target. The bank said that the new value-added tax measures that came into force this week would contribute short-term inflationary pressures, but that these would be mild. For more, I'm joined by Masal Mbala-Ekobena, Head of Equity Research at SBG Securities. Masal, thank you so much for joining us. Now, our market watcher, Ronald Lugalia, that I was speaking to just a few moments ago, insists that investors expected the rates to be held. Do you share that same sentiment?
I think it's always been our view that going to the end of this year, rates were going to be either flat or at best slightly down, but a token cut perhaps by year end. But it looks like flat is the way forward. And yes, this MPC decision is well in line with what we expected.
Should we expect the central bank to be holding in the medium to long term, or is there any movement that we should be foreseeing into the future?
Well, we're certainly not looking at a sort of read across from Uganda, which we looked at earlier on. But the reality here for us is that we will not expect to see any form of tightening well into next year, by which time the growth and stability and the confidence message that we've seen in the MPC statement should have trickled down to broader economic growth, which unfortunately we haven't seen much of so far. So we're not looking at any tightening, as I said, until well into next year.
Let's quickly look at the value-added tax measures that came into force earlier this week. What impact do they have on the inflationary pressures, not only in the current scenario, but also looking forward?
You will note that in the statement, it's mostly food inflation that has come up. Non-food inflation is actually down. When it comes to the VAT, yes, we could argue that it's probably too early to tell, but the reality is also that the central bank itself is not expecting it to have a significant impact, and in any case it's a one-off, and we are still in an environment, or we will be in an environment, where the base effect should still be visible. So net, as much as we may want to be sanguine about new VAT or new taxation, full stop, it doesn't look like it's going to be it's going to have a significant impact from where we stand, or at least for now.
Let's look at this picture from the perspective of the Kenyan consumer on the ground. Walk us through right now how the state of the consumer in Kenya, in light of VAT and also in light of the decision to hold interest rates at 8.5.
I think there are two realities here. The first one is that the VAT is not a blanket tax. So in that sense, we shouldn't be expecting to have an absolute hit from it. And that's something we've just spoken about. From a rates perspective, yes, rates are kept flat, but lending has been recovering very slowly. We're now looking at low teen numbers in July or perhaps even August. But that lending is still far from, or that sort of lending growth is still far from the numbers we probably got used to either last year or the year before last, which were more in the range of 20 to 30%, if not more.
Now, Masal, when we spoke earlier, you shared some insights on investment allocation and how this decision impacts broadly on equity markets. Can you just unpack some of those thoughts?
Well, the reality here is that when it comes to either rates or yields particularly, we are still very much, we are back onto the glide path despite the uptick that we've seen the past weeks or months. In that sense, it is still positive, and we're still very much in an environment where asset allocation would benefit equities versus fixed income to some extent. And in that sense, we have seen the market being a lot more active on the tier 1 names. The tier 2 names have been perhaps a lot more resilient to the small correction we've seen going into results, and there's some form of profit taking that we've seen there as well. But overall, we remain positive about allocation into equities and about equity markets going forward.
Now, there's a very interesting story that was coming out of the Kenyan market this morning, and this is particularly the Capital Markets Authority demanding that that there should be transference of the role of creating and issuing of bonds from the central bank to Treasury. Just give us some insight, Marcel, in terms of how this compares with international benchmarks and international standards, and is there more reason behind the CMA's decision to push for those demands?
There could be a historic reason or just an infrastructural reason for that. But the reality is that bond issuance elsewhere in the world is more of a treasury function. So it's not entirely surprising that it could be that way in this country, especially in an environment where we're looking to raise a Eurobond as well. So perhaps it's more of an alignment rather than a crisis or anything of the sort from where we stand. But then again, they would probably be in a better position to explain their thinking.